Stop scrolling. Close the other tabs. Put your coffee down. Because what I'm about to reveal changes everything you believed about silver. For decades, we were told silver is a safe haven. We were told it's insurance. We were told it tracks gold, up when fear rises, down when confidence returns. That was the playbook. That was the contract between investors and precious metals. That contract just got torn apart. It's Wednesday, February 12th, 2026. And while mainstream analysts are still debating whether silver's January crash was a bubble bursting or a healthy correction, they're missing the real story entirely. They're staring at the price chart when they should be watching the behavior. Because what unfolded in the last 2 weeks didn't just move the price, it fundamentally redefined what silver is. Silver no longer behaves like a safe haven. It behaves like a risk asset. And if you don't understand that, if you don't grasp the consequences of this shift, you're about to be caught on the wrong side of the most violent market transformation in commodity history. Welcome back. If this is your first time here, hit subscribe immediately because what we cover here isn't available anywhere else. We follow the data Wall Street hides. We connect the dots they hope you overlook. And today, we're connecting dots that expose a market in the middle of a total identity crisis. Before we dive deeper, drop a comment and tell me where you're watching from. Are you in New York, London, Mumbai, Shanghai? Because this story unfolds differently depending on your location. The physical market in Asia tells one story, the paper market in New York tells another, and the disconnect between those two narratives is the warning everyone is ignoring. Let me show you exactly what happened, and more importantly, let me show you what it means. The crash that shattered the correlation. January 29th, 2026, silver hits an all-time high of $121 per ounce. Not adjusted for inflation. Nominal dollars, the highest price silver has ever reached in human history. 24 hours later, silver trades at $74, a 38% intraday collapse. The largest one-day drop since 1980, bigger than the Hunt Brothers crash, bigger than the COVID flash crash. This was not a correction. This was a statistical impossibility. Let me put this in perspective. Financial analysts measure extreme moves in standard deviations, called sigma events. A 5 sigma event is something expected once every 7,000 years. A 10 sigma event is so rare, probability models round it to 0. Silver's January 30th crash was somewhere between a 9 and 12 sigma event, depending on volatility calculations. This should not occur, not in a normal market, not in a functioning market, not in a market where silver behaves like silver. But here's what they're not telling you. Here's the detail buried in the headlines. Gold crashed that day. Gold fell 12%, its largest drop in 4 decades. That's massive. That's historic. But look at the ratio. Silver fell 38%. Gold fell 12%. Silver moved 3 times more than gold on the downside. Now flip to the rally. In the weeks before the crash, silver surged nearly 250% in 12 months. Gold was up around 80% in the same time frame. Silver moved 3 times more on the upside too. This is not safe haven behavior. This is leverage. This is volatility. This is a risk asset. Think about it. Safe havens should be stable. They preserve value during chaos. They move slowly, predictably, inversely to risk. When stocks crash, gold rises. When fear spikes, treasuries rally. That's the playbook. Silver just threw the playbook out the window. The moment silver became something else, let me show you the exact moment this transformation became undeniable. January 30th, 2026. The catalyst was the announcement that Kevin Warsh was nominated as the next Federal Reserve Chair. Warsh is known as an inflation hawk. He has publicly advocated for balance sheet reduction. He's the opposite of easy money. Markets reacted. Treasury yields spiked. The dollar strengthened. Equities sold off. And precious metals collapsed. Gold fell 12%. That's a risk-off trade unwinding. That makes sense. Investors who bought gold as a Fed hedge took profits when a hawkish Fed chair appeared. Classic reversion. But silver fell 38%. Do you understand? Silver moved like a speculative growth stock. Silver moved like a meme asset. Silver moved like something people owned not for protection, but for gains. And here's the kicker. When the dust settled, when margin calls were met, when forced liquidations ended, silver stabilized around $80 to $85. Gold stabilized around $4,100 to $5,000. Look at the gold to silver ratio. It went from the mid-40s in late January to 57 to 1 by month's end. That's a violent expansion. That's the market signaling. Silver is riskier than gold. Silver is more volatile than gold. Silver is no longer gold's little brother. It's a completely different animal. This is the transformation nobody's discussing. Silver didn't just crash. It repriced its risk profile. Why did this happen? The paper market broke. Now let me explain the mechanics. This wasn't random. This was structural. Silver's January crash was triggered by margin requirements. The CME group, which runs the COMEX futures market, raised margin requirements to 15% for standard positions and up to 16.5% for high-risk positions. Translation: if you traded silver futures with leverage, you suddenly needed much more collateral. If you couldn't post it, you got liquidated, forced selling, margin calls cascading into more margin calls. This is exactly what happened to the Hunt brothers in 1980. The exchanges raised margins to break the squeeze. It worked then, it worked now. But here's the difference. In 1980, the Hunt brothers were speculators trying to corner the market. They were the weak hands. When margins went up, they got flushed and the market stabilized. In 2026, the weak hands weren't cornering anything. They were retail investors. They were momentum traders. They were buying SLV ETFs, thinking silver was a safe haven. And when the paper price crashed, they panicked. But the physical market didn't crash. Let me repeat. The paper price of silver fell 38%. The physical price premiums on American Silver Eagles went from $3 over spot to $9 over spot. That's a 300% increase. Dealers sold out. Wait time stretched to 6 weeks. Physical buyers didn't panic. They bought more. This tells you everything. The paper market is broken. The futures, ETFs, derivatives, all leverage-based, built on promises, built on the assumption only a small percentage of contracts demand delivery. When that assumption breaks, when people actually want the metal, the system seizes up. And instead of prices rising to clear the market, exchanges raise margins to flush speculators. This is manipulation. But legal manipulation, structural manipulation, it turns silver into a risk asset. The industrial demand won't vanish. Now here's the interesting part. While the paper market melts down, the industrial market doesn't care. Silver isn't just money, it's a critical industrial metal. Solar panels need silver, electric vehicles need silver, 5G infrastructure needs silver, medical devices need silver, electronics need silver, and the industrial demand is growing, not shrinking. The Silver Institute released their 2026 forecast on February 10th, projecting a market deficit for the 6th consecutive year. Total deficit, 67 million ounces in 2026. To put that in context, annual mine production is roughly 820 million ounces. We consume 67 million more than we mine. That's 6 straight years. Where's the extra supply coming from? Above ground inventories, vaults, stockpiles, we're eating the buffer. And here's the problem. Industrial demand is inelastic. When price rises, demand doesn't drop proportionally. Why? Because silver is a tiny fraction of solar panel cost. If silver rises from $80 to $120, it adds maybe 2% to cost. Manufacturers pay. Speculators care. When silver moves from $80 to $120, that's a 50% move. That's volatility, that's risk. Two buyer bases collide. Industrial buyers who need silver at any price and speculative buyers who want silver only if it rises. When speculators are flushed by margin hikes, industrial buyers keep buying. They buy at lower prices. This is why the physical market didn't crash. Real buyers remain. China's export controls changed the game. China reclassified silver as a strategic material in late 2025 and restricted refined silver exports. Why? China is the largest solar panel manufacturer, building massive renewable infrastructure. They need silver and won't let domestic supply leak abroad. China produces about 15% of global mined silver and refines much of the world's silver. Closing exports fragments the global market. Western deficits worsen. Shanghai Futures Exchange silver inventories collapsed from 1.265 million kilo to 350,000 kilo, a 72% drop. COMEX registered silver available for delivery sits at 72 million ounces. Commercial short positions are 291 million ounces, a 4.1 ratio. If 20% of shorts demand delivery, the system fails. Vaults are empty. Promises can't be kept. China's export controls prevent West from filling gaps. This setup explains silver's explosive volatility. The physical market is tighter than ever, but the paper market still prices silver as abundant. The correlation that died. Historically, silver and the dollar are inversely correlated. When the dollar rises, silver falls. When the dollar falls, silver rises. That correlation just broke. During January's crash, the dollar strengthened, but silver fell 38%, 10 times larger than the correlation predicts. Early February, dollar stayed high. Silver rose from $74 to $80, $85, $90. Gold rebounded $4,900 to over $5,000. Silver's rebound was more violent, more volatile, more risk asset behavior. An asset moving independently of traditional correlations is a regime change. Old rules no longer apply. If silver is no longer inversely correlated with the dollar, it's no longer a currency hedge. If it doesn't track gold, it's no longer a safe haven proxy. It's a high beta industrial commodity with speculative overlay. It can rise 250% in a year and crash 38% in a day. That's a risk asset. 6th consecutive year of deficit. Nobody's watching. Let's revisit fundamentals. While paper markets act crazy, supply-demand worsens. The Silver Institute's February 10th report confirmed 2026 marks the 6th consecutive deficit year. 6 straight years of consuming more than mined. Cumulative deficit 2021-2025, 820 million ounces. More than a full year of global production gone. Used in solar panels, EVs, 5G, electronics, industrial applications that don't recycle silver. New supply isn't coming fast enough. Fresnillo cut 2026 guidance from 45 to 51 to 42, 46.5 million ounces. Narrower veins, lower grades, harder to extract. Hecla mining projects 15.1 to 16.5 million ounces, down from 2025. Supply declining, demand rising, deficit widening. In a normal market, prices rise steadily, but not here. Paper market controls prices, flushing 38% in a day regardless of fundamentals. This disconnect makes silver a risk asset. Price now driven by margin requirements, speculative positions, exchange rules. Lease rates are the real warning. Sophisticated investors watch, retail ignores. A lease rate is the cost to borrow silver. Big institutions can lease from vaults instead of buying. Low rates mean abundant silver. Spiking rates mean scarcity. February 2026, London silver lease rates at 4.5%. Average lease rate usually under 1%, normally 0.5%. At 4.5%, extreme tightness. Vaults reluctant to lend, fearing non-return. Lease rates spiked during January crash, not after. Paper price fell 38%. Speculators liquidated. Borrowing costs rose simultaneously. Backwardation on steroids. Spot price crashed, borrowing costs rose. The paper and physical markets decoupled. India bought 36.5 million ounces in 60 days. While West panicked, India bought. Indian silver ETF holdings added 13.5 million ounces. January 2026, roughly 420 tons removed globally in 31 days. December 2025, India added 23 million ounces. Total, 36.5 million in 60 days. Annual global production, 820 million ounces. India consumed 4.5% in 2 months. Investment demand only. If India continues at this pace in 2026, over 200 million ounces, quarter of global mine supply, goes to one country for wealth preservation. They didn't stop during crash, they accelerated. Price dropped $121 to $74. Indian buyers saw a sale, bought more. This shows weak hands versus strong hands. Speculators on margin are weak hands, flushed during volatility spikes. Indian households buying physical metal are strong hands. They ignore daily swings, care about possession. Buying pressure is structural, not disappearing. India's middle class grows. They distrust fiat, experienced inflation. They buy silver and gold, culturally, generationally embedded. Structural buyer consumes 200 million ounces, sort of pash, year. Structural deficit, 67 million ounces. China closes export doors. COMEX vaults at 72 million ounces with 291 million ounces promised. Something must break. The paper-silver system is a Ponzi scheme. Let me be blunt. Fractional reserve Ponzi. January peak, paper to physical ratio 356:1. Each ounce in vault promised 356 ounces on paper. Works if no one demands delivery. Like banks, lending most deposits, works until mass withdrawals. COMEX data early January. 33.45 million ounces withdrawn in 1 week. Nearly half registered inventory moved in 7 days. COMEX total inventory higher. They have eligible silver. Eligible meets quality and stored in approved vaults, not pledged for delivery. Registered inventory backs, futures contracts, being drained. When withdrawals accelerated, exchanges raised margins. Not price discovery, price suppression. Can't deliver metal, make it expensive to hold futures, flush speculators, kill demand by changing rules. Happened 1980, 2011, happening now. Paper market cannot survive sustained delivery demand. System assumes most contracts roll or cash settle. When assumption breaks, system breaks. Scenario analysis. Next 17 days to March 1st, notice day. 3 possible outcomes, none bullish for paper market credibility. Scenario 1, COMEX survives via rule changes. Delivery demand exceeds registered inventory, but exchange avoids default. How? Modify contract specs, allow cash settlement at February 5, low of 64 vault, spot $77. Retroactively adjust delivery terms. Declare force majeure, suspend March physical delivery, force cash settlement. Happened in March 2022, London Metal Exchange. Suspended nickel trading, canceled billions after short squeeze took prices $30,000 ton to over $100,000. They rewound market to prevent bankruptcies. Could COMEX do the same? Absolutely. Rules allow term modification during extreme conditions. Holding March futures expecting delivery? Might receive cash at fixed price while physical silver trades 30% higher. Scenario 2, squeeze resolves via attrition. Margin hikes force leverage traders to liquidate before delivery demand. By March, open interest reduced enough to cover remaining demands. Speculators shaken out. Physical buyers get deliveries. Short squeeze narrative dies. Price stabilizes. Mainstream media claims market corrected. Retail traders margin called at $70 watch elevated physical premiums, 10 to 15%, while paper trades sideways. Most likely scenario. Playbook, raise margins, force liquidations, reduce delivery pressure, claim victory. System survives, credibility damage permanent, everyone saw paper and physical decouple. Scenario 3, system breaks. Even with margin hikes, physical demand overwhelms paper market. Industrial users refuse cash settlement, need metal. Asian buyers drain Western inventories despite restrictions. Retail sees 13% Shanghai, 10% retail premium, demand physical delivery. COMEX registered inventory drops below 80 million ounces by February 27th. March 1st, notice day. Exchange cannot fulfill delivery without emptying warehouse. Confidence in paper market evaporates. Traders realize COMEX futures aren't backed by metal. Paper physical disconnect, undeniable, permanent. Two-tier market, COMEX futures $75, physical coins $95. Spread marks death of paper price discovery. Credibility lost, not regained. Scenario 3, possible. Lease rates 8.2%. February delivery rate 98%. Shanghai trades 13% premium. Bullion banks widened spreads to 450 during crash. They see falling inventory. Persistent delivery demand. March is pressure point. Take defensive positions. Pulling liquidity. Raising margins. Reducing system stress. Tactical playbook. Own physical silver. Hold. Don't panic if paper drops 10% tomorrow. Physical silver ensures against structural breakdown. Cost basis irrelevant. $50, $70, $77. Endgame is permanent divergence paper versus physical. Thesis unchanged. Industrial demand growing, mine supply lags, inventories draining, central banks accumulating, paper market on fumes. Thesis unchanged by CME liquidations. Don't own physical yet? Acquiring harder weekly. Premiums rising, delivery extending, products back ordered. Buy sooner than later. Gap between wait for pullback and no inventory closes fast. Futures, options, traders, understand risk. Overnight volatility can gap, destroy positions. Do not short silver. Do not sell naked calls. Do not bet against physical demand while inventories fall. Lease rates spike. Trade with trend. Don't fight structural bid. SLV or paper ETF holders understand holdings. You own shares and trust claiming silver. If COMEX defaults or paper decouples, ETF may not track real price. ETF may not deliver expected exposure. Metal backing could be allocated, pledged, or claimed ahead. Serious silver investors own physical metal in possession or a vault. Next 17 days, critical. Most intense since Hunt Brothers attempted corner in 1980. February 10, 27, increased volatility, conflicting narratives. Desperate,